I don't even know where we. Hey, okay. So not sure where Leon went, everybody, but he'll be right back. So it is Wednesday. We're coming to you live. And for those of you all who are like, "Oh my gosh, you all are terribly late," you are correct. So we told you all a million times. A lot of these conversations that we have with you all are conversations Leon and I would have anyway. And one of the situations is, or byproduct of that, is sometimes we get caught up in our own topics. So today we're talking about the fact that your investment strategy should have changed already, but if it hasn't changed already, it needs to change today. The mindset about the market, what the market's going to look like going into 2022 through 2022 has to change. And we began to talk about the topic, and we went down a line of research that led us to become 24 minutes late. So if you're still with us, thank you so much. we are normally very punctual, so let's dive into it. Leon's going to tell you why we chose the topic today, and I am going to do the housekeeping.
Yes, the topic today is around, like Brent said, you definitely should have moved. So since November this year, we've been talking about how you want to get out of high valuation, non-profitable tech companies, or just companies in general. And so I know I've done a huge purge out of my portfolio to really pare down a lot of those things that have essentially blown up the last 3 months. So I'm feeling very good about my portfolio. But I think one thing that the point we didn't make, because we were saying, okay, get out of these stocks, they're and move, get out of these high valuation, no profitable stocks and go into other stocks. But we didn't really explain like why that is, right? And so the main reason is one, as we've all seen, the market took a huge hit, and tech is taking the biggest brunt of the hit.
Whoa, Leon. I think we explained why. We went through inflationary environment.
No. I didn't say the causes. I said, but I'm going to say why the main reason behind moving out of the high valuation stocks into more stable stocks. So yes, we did explain the causes, but the reason we're saying do that is I want to make this point clear. It's not to make money, right? Now that sounds ridiculous.
Okay, I see what you did there. I see what you did.
So moving out of these high valuation, non-profitable stocks. So, in the stock market, the whole point is to make money, right? We're all in this to make money. This current environment, it's not about making money. It's about preserving capital. It's not about looking for the moonshot. It's not about getting your 10, 20%. It's about, and I'm actually this is going to sound ridiculous, but it's actually to lose less money than you would if you stayed in those high valuation, really volatile stocks. And what I mean by that is, we're going to show some examples in a minute, but basically what I mean by that is a lot of stocks that a lot of us were in 2020, 2021, where we actually absolutely killed it. We had great years, 20, 30, 40% returns, if not more. Those are now completely underwater. If anybody held on to a lot of those quote unquote COVID stocks through today, you're down anywhere from 50 to 90%. And there's a reason for that, right? And the main reason, again, the reason is that we explained that a million times. Rates rising. Another thing with Russia, we went through that path a million times. But like I said, the main point behind this is it's not to make money. It's to preserve capital or lose less money than you would have had you stayed in those stocks. So an example is, let's say you were in, let's just say Microsoft. This is just random examples. Let's say you were in Zoom, right? And let's say Zoom dropped, over the last 3 months, Zoom is down 60%, right? But history has shown us that companies that make money and that have strong balance sheets and that are, have profits, they typically don't fall as much. So something like a Microsoft may be down something like 20%, where Zoom is down 60%. You're still at a loss in both positions, but the point is you only lost 20% in Microsoft, whereas had you stayed in Zoom, you would have lost 60%. So we're gonna, and yeah, Brent has it up here. And so what we're showing here is Zoom, right? And Brent, could you do like the one year chart? Oh no, sorry. Yeah, go ahead, do the calculation.
So we're going to show you the actual calculation, so you don't think we're just making this stuff up. And when you're talking about a stock that's people just thought it would never go anywhere, it was a high pick for us. Let's start there. But we also told you all when the writing was on the wall, get out. And if you're in the community, you know that we sold our position and we did very well. So sometimes it's not just hold it forever just because, or fight the numbers. Numbers tell a very real story. So let's take a look. The 52-week high, it's right here for anybody watching. And this is actually a great time to share this video in particular, because I know there's a lot of people who don't know how to do these calculations and also are just curious what these stocks have done over the last 52 weeks. So if you're listening to the podcast right now, we have Zoom's 52-week range up. And if you're, again, listening to the podcast or you're exercising, listening to us, at the lowest point, which is today, Zoom is at $120 per share. And at its highest peak, Zoom was at $440 per share. So again, I'm telling for you all, jogging or whatever you're doing right now, at Zoom's lowest 52-week point, which is today, this February 23rd, just for a timestamp, they're at $120 per share. Highest is $440. So what we're going to do is we're going to take 440 minus 120 and then divide it by 440 to show us that Zoom has dropped a whopping 72.7%. That's
from its 52-week high, yes.
So for those of you all who have held on and you were like, you know what, riding until the wheels fall off, that is not always the best case. And for those of you all who are thinking, well, you and Leon always say hold on for 3 to 5 years. If the environment is changing, you have to change too. Mm-hmm. If we say keep your winter coat on for as long as you can for 2 years because we're in the Arctic, if we leave the Arctic and go to Barbados, you should take your winter coat off. And you can't say, well, you all say keep it on for 3 years. We're in Barbados now. So
right,
it needs to come off. So just understand. Go ahead, Lee.
Yeah, no, I'll say with that point, and that's a good point. Because somebody actually brought that up into the platform. And yes, we say hold on to 3 to 5 years, right? Because again, we want to be able to ride out volatility. However, when the environment changed, and we brought this up, we started pounding this drum in November, the end of November last year, saying, look, you got to get out of these high valuation, no profitable stocks. We've been saying this for 3 months now. And we explain why. The Fed raising interest rates, the whole supply chain, like the environment right now that we're in with the stock market is a very tenuous one. And of course, now we have Russia, Ukraine. But as I told someone before, the market is a living, breathing thing, right? So the market changes almost daily. Our guideline is not a rule, it's a guideline of staying 3 to 5 years. It's for a reason, right? It's saying you can ride out volatility. But like I always tell people, I get out of stocks when my thesis around that stock has changed. And with these high valuation stocks, my thesis was, at least for me, my thesis was that these are high growth, high multiple stocks, and typically high growth stocks rise very quickly. Well, my thesis changed when interest rates started to rise. Interest rates now totally cancel that whole thesis of high valuation stocks rise quickly. They do not in rising rate environments. They just don't. History will tell you that. We're all seeing that now in the market. So my thesis has changed. That's when I will make a move out of that. I will then buy things that I then want to hold for 3 to 5 years. More stable stocks, the Microsofts, the Googles, the Pfizers, things like that in a rising rate environment. So yes, we always say hold it 3 to 5 years, but you always have to be aware of the environment around you, right? You can't just blindly buy and say, okay, I'm in this for the next 3 years. If the reason why you bought that stock changed, you got to be able to make a transition out of it.
Yeah. And so we talked about stay-at-home stocks or during the COVID era. And one of the stocks that we were bullish on at the time was Teladoc. And so the symbol is TDOC for any of you all who, again, are listening to us while exercising or doing other things. That company allows for people to have virtual meetings with their doctors. I've used Teladoc. During this COVID environment, I've had virtual meetings with my doctors. I probably will continue to do that sometimes, but more often than not, I'm going in. In addition to that, as any environment, competition comes in. So they are no longer the only telecommunication platform similar to Zoom that people use that is HIPAA compliant, because that was their big selling point, the fact they were HIPAA compliant. So now you've been holding on to it. The 52-week high for Teledoc, symbol TDOC, and again, we're looking at the 52-week range. The highest point was $246 per share. If you look at their lowest hit, the lowest point in 52 weeks, it's $60. And we're estimating is like it's around that. So you can see here, again, if you can't see this, it's just a 52 week range showing $60 is the lowest, roughly 246 is the highest. So let's take a look.
It's right near the lows right now. It's close today at $61, so it's near the low.
Yeah, so probably at some point today is when that low was accomplished. So let's say 249 and 246. So 246 minus 60 divided by 246. They are down a whopping 75.6%
from the high. Yep.
So for those of you all who have mutual funds or you have your ETFs, you may have been shielded from this a little bit, because in many of the ETFs, they would have already had their triggers. The parameters wouldn't have been met for the reason why these funds were put into the portfolio, purchased in the portfolio, and they would have been kicked out after certain triggers would have been enacted. But for those of you all who are individually holding stocks and just weren't paying attention or thought, if I don't look at it long enough, it will heal itself, you're probably praying right now that this self-corrects. And I want to talk about this because Leon and I have said it before. There's a moment in time where you have to just accept the loss. Now, we had one of our podcasts that we recorded, and Leon in particular talked about a stock that he was holding. It went beyond his threshold. He sold it. A friend decided that they were going to. You want to tell the story, Lee, or want me to give the synopsis?
You tell it, because I remember, but I don't. I remember one situation that I held on to it. It dropped 56 some odd percent. But the reason I held on to it because the thesis did not change. The fundamentals didn't change. Nothing with the company changed. It wasn't around interest rates. It was just down for whatever reason, right? The market at that point decided they're going to sell the stock. I held on to it. I ended up getting I ended up coming out of it like a 40% gain after it was down 50%. But again, my thesis did not change. So that was
that
one.
Okay. It was one that you were holding on to and you decided to sell. And a friend was like, well, I'm just going to hold it a little bit longer. And you sold it with a 9% loss, I think it was. But he ended up getting like a 42% loss. And so
I think Oh yeah, that was
no names. No,
not the person I'm throwing the stock.
Okay.
I can't remember if that was.
I mean, the stock is not as important as the story, right?
Yeah, it was. Well, I just know it was Pinterest. Yes, it was Pinterest. Yes.
Yeah, Pinterest.
Yeah. Mm-hmm.
So in that situation, he decided that it was time to sell. He took his loss. You said it was roughly 9% loss.
Yeah, it was like 9 and 10%. Yeah, loss that I took.
9%. Just it's over. It's done. And some of you all have, said, I'm gonna hold on to it. You're looking at 75% losses, because this isn't the only stock that has a 75. The first one was 72%. This is 75. Also, I want to say, for those of you all who have retirement accounts and you're not looking at them, you need to be looking at your retirement accounts right now. Be it a 401k, 403b, 457 plan, TSP, or whatever else you have. Let's ESOP, Safe Harbor, whatever it might be. This is that moment where you need to look at your retirement plan. How's it allocated? Because this is going to be a bumpy ride for quite some time. And your allocation may need to change. And if you have a coworker or you have a friend that's on Facebook, you should share this with them, because the thought behind what's happening in the market is let me tell you the thought. the thought by the average retail investor with this market is, I'm just going to stick my head under the pillow and it'll be over soon. That's not accurate. It's definitely not accurate. It's going to be a rough 2022, but there's a lot of opportunity out here as well. So
And
we don't want to. But
so I just want to make a point on the Pinterest. When I sold Pinterest, the reason I sold Pinterest was because they came out with their earnings and they admitted that their growth had slowed dramatically, right? So and they were even saying going forward, they see a reduction in user growth and a reduction in use. And actually, I believe they actually had negative growth of users. So the growth, the amount of users they were adding slowed, and then some users had left the platform. So the number of absolute users had fallen. So for me, that was, again, my thesis changed. I was looking at Pinterest as this long-term high growth stock that was going to grow users and grow revenues and everything, for the next 3 to 5 years. It was not the case. The company even came out and said that. And when they did, I sold it around 50. A friend of mine sold it around 25-ish. So, you do the math. That's a huge percentage difference when both of us got out. But again, I sold because my thesis changed. And we're seeing a lot of thesis, at least in my mind, a lot of theses have changed this year because of the Fed.
And so there's a list. It's on Market Watch, and we'll put the link to this inside of our community platform. It's just a fun read, and this is not financial advice. We don't know your exact situation. You have to make a decision what's right for you, and you should always, always, always do your research, and know that we can't see your portfolio right now. So what we're saying is generally, this is reasonable conversation for the average retail investor. And so on Market Watch, they had a list of some stocks that were down 20% or more over since their highs in 2021. And you would think, okay, 20%. Okay, let's see what's on this list. This list is long as I don't know what. And some of these companies, you're talking about over 70% drop in the value of their stocks over from the 2021 highs. It's not even saying 52 weeks. So it just says from their 2021 highs, which could have happened in December. So some of the ones that you might know, Mercado Libre, we talked about that. They're like the Amazon for Central America. They're down roughly 34%, according to this Market Watch article. Caesars Entertainment, many of you have stayed there and partied and swam and all the other things you did. They're down 22% from their highest point in 2021. Alaskan Air, I don't know how many of you all go to Alaska, but I'm sure some of our viewers have flown to Alaska. You're talking about a stock that's now down 28%. PayPal, I still hold PayPal. I am not selling PayPal. So, I think, Leon, you sold your PayPal position.
Yeah, I sold out. Yep, sold out of PayPal.
Yeah, I'm in it for the long run. The fluctuation in PayPal means nothing to me. So, that's if it goes down like to 50% though, I'm gonna go because I'm up like 160% in PayPal. So if it goes down 50%, I'm only gonna make 110% profit, which I'm cool with. So CrowdStrike, some of you all who are investors, you're familiar with them. I'm talking about 30%. Trip.com, 48% drop since their highs in 2021.
T-Mobile.
I was just gonna say I'm gonna do two more. T-Mobile down 21% according to this Market Watch article, and Enphase Energy is down 33% since its highs in 2021. And so you all may be thinking like, okay, you all just freaked us out thoroughly, but what does this mean for us, the investors? It means there's a lot of opportunity out in the market, depending on what your financial situation is. If you can stand to pick up some of these discounted stocks that still have good fundamentals and have strong leadership and are well positioned in their market, this is not the time, I believe, and I think, Leon, I can speak for you, to chase the news or chase fads. This is not that moment in time. If you're looking at speculative stocks, I wouldn't do anything with SPACs right now. Special acquisition companies. What's your sentiment on SPACs, Lee?
No, I mean, they're SPACs are the poster child for. Hey, Brent, can you pull that list back up real quick? So
Yes.
SPACs are the poster child for this what we're going through right now. Because remember, again, the problem is rising rates, which affects companies that don't make any profits, right? A lot of these SPACs that came public have no profits. I mean, last year a lot of people think. I mean, effectively was last year was a gold rush for celebrities and fund managers to just puke out all these companies. I mean, literally, I mean that's what was just they just puked out a whole bunch of companies that really weren't ready for prime time, and a lot of those companies have been cut in half or more. So Brent pulled the list back up. I just want to make a point. So remember, Brent and I went through the exercise earlier. TDOC, right? TDOC is a revolutionary company providing these telemedicine services to individuals. TDOC is right now down 75%, right? 75%. Zoom. We all love Zoom. Brent and I right now are using Zoom. We use Zoom every day.
But I don't own it anymore.
Yeah, right. I don't own it anymore, but we use Zoom every day. Zoom is down 72%. All right, Brent, can you go back to the market watch?
Yep. And real quick, Leon, let me jump in. This is one of those moments you all hear me often talk about, stocks that you use, stocks that you believe will be here every day. It doesn't necessarily, and this is why I say it doesn't. I'm not saying just because you do that, you should own it. I do not own Zoom. We are on Zoom. I use Zoom almost every day. But the competition, even for Zoom, their business model, I don't think anything has changed, which I think is the problem. So much competition is coming to the market for virtual meetings. And also now you have the metaverse and you have all these other platforms that are just sucking their client base away from them. I don't think they're coming back. So, I mean, that's me personally, but I just wanted to show this is an example of a product that I using it right now, that I don't own. And I know I often talk about that, but it's not 100% of the time. And you all should know not everything's all the time for everybody in every situation.
Yeah, exactly. Yeah, exactly. That's kind of the point I kind of made too. Is like I use the Walgreens example. If you bought Walgreens 4 years ago, 5 years ago, you'd be down 50% on your money. A lot of us know Walgreens. A lot of us use Walgreens. Walgreens has been a terrible stock the last 5 years. So back to this. What I'm talking about here now. So the reason I asked Brent to pull this back up is because I want to make the point. I want to make the distinction between high valuation and or non-profitable stocks and stocks that do make money, right? So again, TDOC makes no money right now. They're down 75%. Zoom actually does make money, but their valuation was in the stratosphere. We've talked about PE values before. We're not going to go into it now, but their PE value at one point, I think, was like 200.
Just the price to earnings ratio. Just we're not going to go into it, but at least define it.
Right. Yeah, price earnings ratio. I believe it was like 200 or 300. Just a point of comparison. The PE value for the S&P 500 is like 20. Right. So, and that's typically the kind of the benchmark people measure things stocks against. So the PE value for the S&P 500 is about 20. Zoom's was like 200 and something. So that gives you a relative comparison how expensive Zoom was. Even though, and we've said this, we've always said, we said it's either non-profitable or high valuation. Those stocks have gotten crushed. Again, Zoom down 72%, TDOC down 75%. Now, the list Brent has up here, Southwest Airlines. We all know Southwest. I fly Southwest. A lot of us fly Southwest. Southwest is only down 34%. Now, I'm saying only. Remember, I said earlier, part of this is the one to either not lose money or to lose less money than you would had you stayed in those high valuation stocks. Because, I mean, frankly, in this environment, you can't avoid losing money, right? It's just everything is going down right now. Just the mood of the market, we can't get around it. But what we want to do is we want to get into stocks that will lose less. So here we have Southwest down 34%. What's another big name? Match down 27%. Like I said, we had T-Mobile
so
down,
I'll say this.
T-Mobile down 21%.
This is, you guys are getting some free advice right here. Even though Match is down, I'm still going to hold on to Match. Match has been an absolutely incredible platform. And they're profitable. The fundamentals are amazing. The management is amazing, and they're very innovative in a way that they own way more companies than you probably know. Like, if you really dissected Match, I'm highly impressed by this company.
Yeah, but, I mean, Match. I agree. Match is good, but in the relative comparison, Match is not really down much at all, right? Match is down what, 27%.
7%.
But again, Zoom, Teladoc, Zoom down 72%, Teladoc down 75%. This is why we were saying get out of these high valuation, non-profitable stocks and buy stocks that do make money and whose valuations were lower, because they'll drop less, right? I mean, like I said, you're gonna take a hit. I mean, everybody is, but the point is to take less of a hit if you were to stay in these high valuation stocks. So I just want to make that distinction, showing that things like TDOC, things like Zoom are down over 70%. Companies that make money and that have profits and their valuation aren't as high are down much. I mean, these stocks are down half of what TDOC and Zoom are.
Yeah, so, you got Walt Disney only down 23%.
Yeah, up 23%. Yeah. We got what, Phillips 66, a oil company, down 21%. I believe they pay a dividend. Boeing down 26%. So these are, again, being down is terrible, but it's relative. It's relative to what you would be down if you stayed in those high valuation Roku's, Zooms, Teladocs. If you stayed in those, your portfolio is, yeah. I just feel bad for people that are still sitting in these. And wait, I'll make one last point on this. So Brent and I have a disagreement on this one too. I sold my entire position in Facebook. Facebook is considered, Facebook to me was a core holding, right? So I have a certain number of stocks that I buy no matter what. I just buy them. I buy them blindly because they're what I consider to be blue chips, the Microsofts, Home Depots, things like that. Facebook was in that group, right? Facebook came out, their last earnings was so it was like catastrophically bad.
Dude,
right?
the metaverse.
And that's my point. That's my point.
It was a bad decision.
So one was the metaverse. Mark Zuckerberg came out and said it's going to take 10 years and tens of billions of dollars to build out this metaverse, right? In 10 years. We have no idea if it's going to be successful. The biggest issue though is that when Apple made their, I don't know a lot of people know about this, but yeah. Apple made a change to their phones. And so now Facebook cannot access a lot of that data that Apple used to provide. Facebook came out and said that because they cannot access that Apple data, it's going to cost them $10 billion in revenue this year alone. In 1 year, $10 billion. And they said they're spending $10 billion this year also to build out the metaverse, which again is just this thing that they can't even define, right? So, but the thing that really spooked investors and why the stock is down so much is this was the first time in Facebook's history that they had negative user growth, meaning that they had less people on the platform the last 3 months. People left, right? Some people left Facebook and went to other platforms. Mark Zuckerberg was on the call, and they said it sounded like dude wanted to cry. He mentioned TikTok like 20 times. He fears TikTok because he basically said they're eating their lunch right now with kind of the new generation. So all that being said is why I dumped Facebook. I got out of my entire position. I got out about around $240. Today, Facebook closed at 198. So now, I'm not saying like I'm some genius and I know what the future is. Facebook tomorrow could turn around and go back up to 400. Who knows? But again, my thesis around why I own Facebook as a core position has completely changed. I think Mark Zuckerberg is mismanaging the company. Their user growth is slowing. Their revenue is slowing. It's to me, it's a disaster. So
when we get no SEO reach on this video, everyone will know why.
Right, we're on Facebook right now. Yeah. Hey, gotta give them the real.
The truth is the truth. So I don't disagree with Leon. Now you got to understand, I got into Facebook a few years before Leon. I got into Facebook like I don't even remember the year. It was Facebook. I feel like it was at like $20. It was something stupid. Mm. So when I first got into Facebook, I am now probably looking at about a 900% rate of return. Probably it's like 700 now because of what's been going on. So I'm like,
it's got a high class problem.
Yeah, so I was like, it's not. So I will say this: if I had recently got into Facebook and I was hemorrhaging money at this point, because that's what's going to happen, and I needed that money for something in particular, I will be 100% in alignment with Leon. And one of the things that, on the flip side, on the cryptocurrency side, I sold out my entire position in Bitcoin. and I was like, I don't see this thing going well for some time. And I sold out at 55. It dropped to 30, 39, 40.
Yeah.
I'm not saying it's not going to turn around. Like same thing Leon said. I'm not saying it's not going to turn around tomorrow. I just, I agree with Leon. If you got into Facebook recently, if you don't need the money, see what happens. If it's not a critical amount of a weighted average inside your portfolio, if it's less than a 5% position in your portfolio, I say, see what happens. Give yourself a floor though. Give yourself a floor like right now. And I will openly say this. You have to take the emotion out of Facebook because the world is changing. Social networks are changing. I don't know where it's going to shake out, but they still have Instagram. They're still hanging on, but it's the user base is looking at different platforms. And again, the reason why Facebook puts so much time and energy into Meta, the metaverse, is simply because they thought if they could be first to market and get ahead of the curve, everyone will flock to their platform because they have such a strong user base. Clearly, that's not the situation, and we don't know what the future brings for the metaverse. Because what you have to understand, I think, what does meta mean? Beyond. I think meta means beyond. Verse is a representative of universe. So when you say metaverse, it's beyond the universe as we know it. I think that's the thought process behind metaverse. So you can build one anytime you want. Anybody can build a new world. So you don't know who's going to build the new world tomorrow and make all of this stuff completely irrelevant. So I'm, all that to say, I'm not far off of what Leon's saying. And I think you have to look at when I bought Facebook, because having, 800, 900% rate of return on this and being down to a 700% rate of return isn't so bad.
Yeah, you're not tripping. Your situation is different probably for most people. So yeah, you're playing with house money right now. So it's
yeah,
all
so
good. Yeah. But the reason I wanted to bring that up was because so my point with that was we've been saying get out of high valuation, no profitable stocks. And a lot of those are pretty new and speculative stocks. Facebook, I think a lot of us probably own, a lot of us use, just because it's a big, and this is what Brent said earlier, you have to pay attention and understand what you own, right? You can't just, we're not saying be in it every day like Brent and I are, checking your portfolio every day, reading news and all that, but at least check in every 3-6 months, as often as you can, just kind of see where your portfolio is, how the company's doing. Because again, right now, Facebook is down massive. I think Facebook's down 40% from, I believe, from its high. 40%. Facebook. This is Facebook. This is not like some rinky-dink company. This is Facebook. Is down 40%. So I brought this up to say that yes, get out of those high valuation, no profitable stocks, but you also have to be aware of your portfolio, because when a company like Facebook can drop that much in this short amount of time, means pretty much anything can. So you got to be aware of what's in your portfolio. And like we both said, Facebook could come back tomorrow. I could be wrong, right? And the thing is, I'm not wrong, because I got out because of my thesis. Because I got out because my thesis changed. Like Brent said, his thesis is different. He's been in the stock for, I don't know, 5, 6, 7 years. He's up 900, 800%. I'm not, right? So again, everybody's situation is different, but just be aware that even stocks like the mighty Facebook can fall and fall rather quickly when they don't meet the street's numbers.
And Facebook has been gambling. Let's call it what it is. They've been rolling a dice and trying to get ahead of technology, and it's caught up to them. You can't think just because you're Facebook, you can always beat the market. So it's
and also we're not saying Facebook is not going anywhere, right? Facebook is they're a cash cow. They're as far as advertising platforms, it's really only Google and Facebook, right?
Facebook no YouTube.
No, I'm saying the big two. There's after because Facebook and Google own like 85-90% of the market of the digital ads market.
Oh yeah.
So that's what I'm saying. They're like
together, yeah.
Yes, yeah, together. They're like the big two. So it's not saying Facebook is going anywhere, but what I'm saying is how Wall Street values Facebook is changing, right? So Facebook will be around probably past all of us watching, but just because their stock was recently worth, I think $330, Wall Street right now is saying it's not worth that. So the valuation metric has changed. The thought in Wall Street's mind has changed. So we're not saying Facebook's a bad company. They're still going to make a lot of money, but our goal in this is to make money via their stock. And right now, Wall Street is saying their stock is not worth what it was because of all the issues surrounding Facebook right now. So again, you just got to be aware of what you own and pay attention to it. To the stocks.
Yeah, let's take a look for Facebook. Let's see. All right, this is Facebook's chart that we have. Meta platforms. And just to have some fun with this, looking at the 52-week high, it was at $384. Their 52-week low was $98. Guess when that happened? Today.
So, no, 198.
98. I'm sorry, 198, and it happened today.
Today, right?
So at their high, 384. So let's have some fun. So 384 minus 98 divided by 384. They're down 48% from their highs.
And that high was about 2 weeks ago. So they're really down 48% in about 2 weeks.
Wow. So you're talking about a 48% drop. And we talk about this often. You have to understand the emotional state of investing. If you all are terribly freaking out when you hear this news, you should be thinking, am I overweighted? Do I have too much of this one stock in my portfolio? Is it 40% of my portfolio? Is it 20% of my portfolio? Is it too much? This is called single stock risk. And unless you really know what you're doing, or you have the money to absorb what the risk factors are that you're taking, you should not have single stock risk in anything. You want to have certain caps. Leon, I think, does 6%. I would do up to 10%, depending on what your portfolio looks like of any one stock. And that way, when situations like this, if the stock went to zero, you still have 90% of your portfolio still intact. But when you're investing, you have it as 40%, like the one stock is 40% of your overall portfolio, or in which, we're talking about 40%. If you have $100 invested, that means $40 of it is in a Facebook or a Meta. And so that drastically can pull your account. You really want to look at your asset allocation like now, because these stocks could truly hurt your portfolio because we don't know what the rest of 2022 is going to bring. But again, we don't want to end on gloom and doom. So we do want to also say, if you have the money, and this is definitely a dry powder situation, laying around, and you want to invest in some of these more stable companies, they're not only going to weather the storm, they're probably coming out on the other side stronger, because during this period, you'll see a lot of acquisitions. And you need to understand, these bigger companies with very deep pockets are looking at these smaller companies like, which one do we want to buy? Which one is going to add to our overall position in the market? Or which technology do we need? Or what patents do we need to acquire? Different reasons why they buy smaller companies. But bottom line, this is an environment where those things do happen, which can hyper accelerate those companies when the market stabilizes. So just, if you can dollar cost average, pick quality stocks, strong fundamentals, strong management, good market position. And you want to also look at the possible serviceable market, but that's going somewhere different. Dollar cost average into, that's called dollar cost averaging down, because as the price drops, you're still putting new money in. That benefits you when the market turns around. So we're not saying run, hide in the, don't do the ostrich move and put your head in the sand and just hope nothing bad happens. Because reposition yourself, but still continue to invest for the long term, if you can.
Yep. And this time right now, we're going through this rough time that we're going through in the market. Is so people that were investing during COVID, that was a lot of people's first experience. Problem with that was a lot of people joined the market after the bottom. They kind of rode it up, right? But those of us who were in at the time, the market dropped. Right now, the market is down. So today, the NASDAQ futures is down 20%, which means that the NASDAQ is roughly down what they call in bear market territory, right? 20%. The S&P 500 is down about 15%. During COVID, and that's over the last 12 months. So we're down that much over the 12 months. During the COVID drop, the market dropped 35% in 1 month. So that showed you how violent and rapid the COVID drop was. So those of us in the market right now, if you're experiencing this kind of this rough time, this was nothing compared to what COVID was. COVID was a whole other level. But anyway, people that rolled that out, that were in it or not. Brent and I say we've done lives on this. These are the crashes are the best. This is when billionaires and millionaires are made. It's when people that can tolerate it, that understand how markets work. Brent said that they dollar cost average in. They don't have single stock risk. They kind of spread their money around. When you buy these times, like I'm mad. I mean, I've adjusted my portfolio crazy over the last month. Like my portfolio doesn't look the same as it did the end of last year. I wish I had a bucket full of money. I could just plow into the market every single day, because every day I see it drop, I just salivate even more. But I mean,
So
it's
Leon, let me jump in real quick. So you're salivating watching the market. Somebody dumps a bucket of money in your lap right now. Which stock would you buy? I'm putting everybody. So if you stuck around this long, you get the good stuff.
I actually wouldn't even buy a stock. I would buy an ETF, and the ETF I would buy is XLK. Here's why. XLK is it's a technology sector ETF. It's right now. So I was talking about something called relative strength. XLK has dropped less. It's dropped, but it's dropped less than the S&P 500, less than the NASDAQ 100. Those two. So basically, the XLK has dropped less than the market itself. So it's showing strong relative strength, and it owns everything. It owns Facebook. It owns Microsoft. It owns what's another big tech company? It owns Tesla. Whatever you name it, any Apple, any big tech company that it owns. But it's spread across. I think there's like 100 and some odd stocks in there. So it's very well diversified. Like right now, Facebook is down huge, but XLK is not feeling it so much because it's spread across 100 and some odd stocks. So it's like I said, I think it's down about 10% from its highs. So I would buy that, because I would be buying into all of the major tech companies. Some of them will major and some small ones, but all the tech companies that are down huge right now, that in my opinion will come back roaring once we kind of get past all this craziness.
All right, you got it.
What about you?
Smile by there. So actually I would get Tesla. Tesla is right now about like at least 60% down from his highs. At least 60, probably more than that.
Mm.
And it's where they're moving with battery technology. I don't care about the cars, but where they're moving with battery technology and some of the space travel through SpaceX, a lot of the technology trickles down to Tesla. I mean, that's just the way Elon Musk moves. So I would increase my position in Tesla.
Okay.
And just profitable.
Yes, and they're very profitable. Yeah. So just real quick on XLK, the top holding in XLK is crazy. It's Apple, and the weighting is 25%. The next highest holding is Accenture at 2%. So Apple is a very, very big portion of XLK. But it's made up of 100. It's made up. Damn, I thought I had over. Sorry. I take it back. It's made up of 80 different companies. Apple has a very huge weighting at 25%. But then there's 79 other companies that make up the rest of it. So it's very well diversified. And I own it in my personal my account now, but I would add to it if I had a bucket of cash.
So before I answer, people were like, Brent, what about you?
Yes.
But I mean, so I'll say this, and let's just have some fun. I would put some money into Amazon. I put some money into Coca-Cola. I would put some money into PayPal, Square. I definitely would do Bank of America, Wells Fargo, probably Costco, and you believe it or not, I would put money into Amazon right now, and I would be looking to scoop up some of the some of the EV market that got decimated. So I would kind of drag a net through EV marketplace and just scoop up all kinds of companies with the thought that somebody has to win. So understand, my strategy wouldn't be like, oh, every single one of these is going to win, but they have been decimated. And once the recovery comes, we're going electric. It's
It's mandated by governments. Yeah, it's
Yeah.
mandated by government.
So when you look at that, and you're talking about less than a 6% adoption rate of EV cars right now, and I was also look at some precious metals, but not the way you probably think. I'll be looking at the recyclers to see who's recycling what metals that we're going to use in technology into the future.
Yeah, I like that. I would actually speak of metals. I would do I would invest in lithium, because
Yeah.
lithium is I think is the main ingredient in EV batteries. So I would look at lithium as a metal. And
That's
their
why
way to do their
Elon Musk is
ETFs.
buying lithium mines.
Yeah, and there's ETFs that you can do that through. Actually, we'll post that in the membership platform.
Yeah. So, this is one of those, if you're gonna stick around, this is what happens when you stick around. We just dump
some gems.
we dump it all out.
Yeah.
But it's also too, it's important that you understand the mindset right now. Panic is normal. And a lot of times we have these emotions and we don't know what to do with them because no one told us it's okay. It's like if you feel sick and you go to the doctor and the doctor was like, oh, well, you had a blueberry and you're allergic to blueberries, so you'll be fine. You're like, okay. You leave still feeling the exact same way, but because the doctor said it's because of this blueberry, you feel better somehow. So hopefully this can be one of those moments where we can say, yes, you probably feel like crap right now looking at your account.
Because I do. Yes, I do. Yeah. I'm right there with you. Yes.
We're all with you. But Leon and I have cut our teeth on markets like this before. Mm-hmm. And what we know is we're still investing through this, but we're reallocating through this. Mm-hmm. And so where some of my positions, I know I'm going to hold just because I've had them so long. And I think I've been investing in the market over like 20, 30 years, but I've been in some of these positions like 9 years. So right now, this is just a blip on the whole radar, which is why we always say time is hugely important in the market. Because what we're talking about, then Leon said, well, Brent's holding it, and you guys probably were like, Brent's holding it. but then I come back and I tell you, I'm at 700% rate of return.
And you've been in for like 8 years or something.
Yes.
So it's different. Yeah. I've only on Facebook for maybe a year and a half. Because remember, just so everyone know, I was big in the futures and options for years. So I've gotten in, but I've always been in the stock market kind of on the side. But I really dove into it hard a few years before COVID. So Brent, we both in the market for about 30 years. Brent a lot more than me. Even when I was on options and futures, I was still in the market. It just wasn't active. But I've been a lot more active the last couple of years. So that's why Brent has a little more of a lead time on me on some things, like 700% return in Facebook.
But I always had the dollar cost average mentality in it. Mm-hmm. I mean, for those of you all who are watching this the first time I bought it, I bought like $200 worth, which was a bunch of shares back then. But which is why now I'm just like, eh. So you have to look at time in the market, not trying to time the market. On the flip side, right now we're telling you it is a good time to get into the market. This is the moment where you need to pick quality companies that have been affected by the environment that we're in. Quality companies. It's not speculative. We've said it 10 million times on this live today. And so if any of you all come back saying you guys are speculative stuff and you when it went to zero, we tried to tell you.
And also we said it before, say it again. The 3 to 5 year rule thing. 3 to 5 year is a guideline, not a rule. You have to be able to adjust your positions, your mindset, your thesis for whatever reason you got in the stock. Like again, if the reason you got in the stock changes, why would you continue to own it? For me, when companies say out their mouth, user growth is slowing, we're going to lose $10 billion this year because of a bet we're making on a virtual world. Like, I mean, you have to look at your own reasons. But again, if the reason you got in the stock changes, you have to make a decision. You either want to ride it out, see if they fix it, or you get out. For me, when my thesis changed, I've learned my lesson over the years that whole playing the game of hope. Oh, hope it'll come back. No, I'll just cut my losses and move on.
Yeah, hope is not a strategy for success.
No, hope is not a strategy, right?
So, and we're telling you all, like, we're putting a lot of time into this live in particular because it's going to be another week before we talk to you, and things may go further south in this next week.
And on that point, I'm as we're talking, I just saw something come across. Putin has just announced that he's carrying out military operations in Ukraine now. So let's see how the market looks tomorrow. If for anybody that knows about the futures, if you check NASDAQ or S&P 500 futures, may get a little ugly, but tomorrow might be an ugly opening. But it also could be a bounce. Again, we don't know, but that's not a very good headline.
No, that's not a good headline at all. And it's going to have global impact as this whole thing has happened, because at the base of everything that's going on, it's financial. Like, it's all about financial position. So that's something we can go into. It's a whole nother conversation.
Yeah.
But for those of you all who stuck with us, thank you. This has been fun. The messages are just coming in. I'm excited. I feel like there's a huge opportunity. Marcus, we understand that. We agree. Smart opportunity. Malcolm Echo decimated. Yes. We
feel your pain, bro.
Jessica said my Amazon is down like 16% at the moment. That's nothing.
That's good. That right there, that is a good. Again, you'd rather be down 16% than 75% in Zoom or Teladoc. So that's actually a good thing, relatively speaking.
Yep. And Dominic said meta is also a term used in coding. Yes, metadata. And Malcolm said also no more FANG. We're not saying no more FANG. We're just saying that the F in FANG is effing up.
Yeah. Maybe it's not FANG. It's ANG. Drop the F. Again, you have to make the decision. We're not telling you. We're just saying what I've done. Brent is in it. I dropped it. You got to make a decision for yourself. But I gave my reasons why I dropped it. If you feel me, you may want to join that cut it bandwagon. But
yeah, I'm not married to it, though. I want to be very clear for everybody. Like, I'm married to Tesla. Like, I don't like, it's
because like half your portfolio is Tesla.
Yeah, like it's very few things that are going to shake me on Tesla. And it's talking about 50% cut, and I'm still like, so.
But again, you're up like X amount. Huge percentage.
Well. But but I am not married to Facebook. Like, I'm gonna have my limit, and when it hits that limit, I don't know what it is yet. I'm still figuring it out. I'm not gonna stay with it just because I've been with it that long. So just understand there's a time to stop and cut your losses. So with that being said, and honestly, with the opportunity cost, I'm more than likely will sell a big chunk of my position in Facebook to take advantage of the opportunities in the market. So yeah, actually, I just made that decision like just now. So
yeah, there's a lot of good ones.
So I'll probably do that tomorrow, Friday.
Do that tomorrow morning on the open.
Yeah, might try to put my trades in tonight. But anyway, we're going way off. This is one of those days. We talking. So everybody, thank you for sticking with this. I think Leon's pick today is XLK. And my pick, for those of you all who want to go over to the group, if you're a member, you can still go to a group. Although we dropped a lot of different stocks on this one, I'm going to tell you that the pick that I have is different than what we talked about. So if you're interested and you're a member, you will be able to see my pick in the platform. You'll be able to see Leon's pick in the Facebook group. And for everybody who wants to become a member, you can go to www.investingeducationacademy.com, and we will be happy to have you as a new member. Again, www.investingeducationacademy.com. And for those of you all who will be watching us when we're speaking this Saturday for the NAACP event, thank you for registering to check out what we have to say. That one is going to be completely focused on cryptocurrency. They contacted us to cover cryptocurrency for their Money Matters seminar. So we will be in the house. So we are super duper excited about speaking for the NAACP on cryptocurrency. And it's because of you all's support. They noticed us and they contacted us. So thank you, everybody. Have a good day.